we will now move on to strategy number 3, which is you can use in your business by way of prepaying certain expenses. And how can you legitimately move some income between the financial years to able to get the best tax outcome in that particular financial year or the subsequent year. So there are certain deductions which are available to you where you can make a prepayment for the next 12 months and and then be able to claim the full deduction for that prepayment in this particular financial year. So let's say if we are looking at 30th June 2020 and we take an example of an interest payment on your loan, if you decide, and if let's say that loan is your business loan and you decide to prepay an interest on that for the next 12 months, you should be able to claim that full deduction in this particular financial year 2020. And that could be, let's say, if you're not running a business, but you have an investment property or a rental property on which you can prepay your interest, then you are able to claim that as well. But just a couple of things to note there that you need to talk to your bank. So you need to give them a little bit of a notice in advance. Sometimes this generally doesn't work very well if you go in the last few days of the financial year to the bank. So just make a note of that. You allow enough time to give your bank a notice that you are intending to prepay your interest for the next 12 months. And in certain instances, you might be able to get a better rate or a little bit of a discount from the bank as well on making a prepayment for the next 12 months. But if you have a fixed rate loan with the bank, you will not be allowed to prepay because unless you decide to break the fixed rate, convert into variable, and then prepay, and then you need to do the calculation to make sure that the break fee is not detrimental to the whole tax saving you will achieve by prepaying the interest by converting into variable, and you may be going into a higher tax rate as well if you convert from fixed to variable. So the next item is also in regard to some of the other expenses. Um, so I'll go to the next slide. So some of the other expenses which you can look at prepaying are your rent. So you can negotiate a prepayment of the rent. Let's say if you're already in a fixed lease and in a particular financial year you have a higher income and you want to make use of a prepayment of a rent, you can negotiate with your landlord and you might be able to get some discount on the prepayment as well, and at the same time use that as a tax deduction. Similarly, you can prepay some of the insurances, etc. as well. But you have to be, of course, mindful of your cash flow. So that's why a little bit tax the overall planning is required. That if you're going to use or block a certain portion of your cash flow in prepayment of certain expenses, that you are not in a cash flow crunch as a result of that. Also, one aspect to be noted, as a lot of those businesses who are eligible for cash flow boost under the COVID, uh, the cash flow boost is a non-assessable, no, it's a non-assessable income, but it will. So it's not tax exempt, but it's called NAINS, non-assessable income, which normally absorbs any losses. So just make sure when you're doing any prepayment or tax planning strategies, if you end up in a loss in that particular financial year, that not be very beneficial, because you will not be able to carry forward that loss if your cash boost payment is more than the value of the loss, and that loss will then be absorbed by the cash boost. So it will not it will not be a very good outcome if you want to looking at carrying forward some losses. um, Now, just deferring the income or legitimately moving income between the two financial years. Now, there could be certain genuine instances where your income could be moved from one financial year to the other financial year. Some of the incomes are taxed on receipt basis. So, let's say for your dividend or your interest, if you're expecting to receive on any particular loan or an investment, that it's possible that you might defer the interest receipt of that interest income to the next financial year. It's also possible that if you're not looking at having a delivery of any particular good or service done before the end of the financial year, but you're looking to issue an invoice, but either you defer the issuing of that invoice to the next financial year because you're not expecting to deliver that good or service, or if you have issued an invoice because you want to receive a deposit or an advance from a customer, make sure that you treat that appropriately, because then it should not be part of your sales if the goods or services have not been delivered. Um, it could be different where you're doing a progressive work. Let's say if you're a service provider, but you're doing a progressive work and you issue an interim invoice, well, that is against a part of the service which has been rendered. So that will become part of your income. But in certain situations, you only issue an invoice to get an advance or a deposit. That will, I mean, you normally would just think that should become part of the sales, but that could just be an unearned income, which can just go into your balance sheet and not in your profit and loss account. Now, just an example in case of capital gains, just try to, let's say if you have multiple assets, example shares or properties, and some are at the moment trading at a profit and some are trading at a loss. If you are looking to sell those assets in a span of few months or during in a short duration, try to time the sale in a way that either the one of the assets which is going to be sold at a profit, and the other which is going to be sold at a loss, they are either both the transactions are done within the same financial year so that you can offset the loss against the gain. But if both of them can't be done within the financial year, then just see whether you are able to sell the one which is at a loss before the financial year ending, and the one with the capital gain or a profit in the next year. Because if you sell at a loss, you will be able to carry forward the loss to the next financial year and utilize that against the profit or the gain you will make in the next financial year. But if that is not in that order and you make a capital gain on a particular asset within this financial year, you will have to pay the tax within this financial year. And the next year, when you sell the one at a loss, then it is not going to be beneficial to you because that loss will then sit there, or you will have to carry forward for any future gain to be offset against. But you will lose the advantage of not being able to offset against the gain which you've already made in an asset in the previous financial year. So that's just a little bit of a timing issue. If you are able to do that, in a lot of instances, it happens a lot of times in the case of the shares, which are more frequent transactions. People then don't pay much attention, and then don't get the best outcome. All right, we'll move on to our strategy number 4, which is how can you look at your bad debts and the trading stock, or your accounts receivable and the trading stock, and